Okay, this talk is about proof of stake, or more precisely about a hybrid of proof of work and proof of stake that we call proof of activity. And this is a joint work with Charlie Lee, Alex Mizrahi, and Manny Rosenfeld. Okay, so the first question is if Bitcoin isn't broken, then why are we proposing to fix it? So the main concern of our analysis is to alleviate future threats on Bitcoin. And what we are mainly concerned with is that when the block reward subsidy ends and the miners earn their rewards, they earn all the revenue only from transaction fees, then it is likely that there will not be as much mining power devoted to the security of the network against external attackers. So basically, if you remove a subsidy for work, then you will get less work. So we will get to that. And the other future threat is centralization. So if the proof of work mining process becomes controlled by large data centers that instead of a decentralized network of hobbyists, then basically that's bad. So if you only have several designated data servers that control the network, then you actually don't really need proof of work. And we also claim that there are a couple of side benefits to our proposal. So one is lower transaction fees to the users. Another is more efficient energy consumption overall. We strive to have a better network topology. So if currently you as a user hold some Bitcoins, then that doesn't imply that you also participate right now in the decentralized network of Bitcoin as a network node, and we try to create this incentive structure where the users will participate, and will be online in this network, and that is how the name proof of activity is derived. So the users will be active in this sense. And also greater incentives to maintain full or archival nodes. So a full node is a node that can create the current blocks on the Bitcoin blockchain in a trust-free way, and an archival node can also bootstrap new nodes by feeding them the entire history. So we also create incentives for that. Okay, so let's try to describe the objective of Bitcoin. So a robust cryptocurrency like Bitcoin should strive to provide an incentive structure under which it is in the self-interest of the different participants in this system to sustain the health of this system over time. So wanted to mention that this is nothing new. So this is from 1788. So this is James Madison in the Federalist Papers. It's a very famous quote that if men were angels, then no government would be necessary. And I also highlighted the later part of this quote where he says that the Constitution should oblige the government to control itself. Yeah, so also in the title here, so like who watches the watchmen, so if there are designated entities who are supposed to maintain the security of the system, so what are the mechanisms that are put in place to make sure that those entities don't become corrupt? So if there are no such designated entities, so we're trying to have a system that is decentralized, that anybody can help in the security maintenance, and that it will be in the self-interest of this participant to sustain the health of the system over time. Okay, so I highlighted in the previous slide the word different participants. So this is just a slide about some definitions. So there are non-mutually exclusive participants in Bitcoin. So there are miners who perform difficult computational tasks. There are the network nodes who actually broadcast and receive messages on the decentralized network. There are the users who wish to spend or receive the crypto coins, and there are stakeholders who possess these crypto coins with the expectation to spend them later. And the definition of a proof-of-work-based cryptocurrency is a protocol that gives the decision-making power over the continuation of the ledger history to entities who perform difficult computational tasks. And the definition of a proof-of-stake-based cryptocurrency is a protocol that gives the decision-making power to entities who hold stake in the system, who have coins. Okay. Okay, so let's discuss in a little more details the problem that we see that lurk in the future for Bitcoin. So the issuance of the money supply in Bitcoin started with 50 coins per block, and this halves once every 4 years. So when this subsidy will end, then the security of the network, the revenues that go to the miners will be by means of only transaction fees that are derived from the actual commerce that is taking place. And so right now the reward is 25 coins, and in 20 years from now it will be 0.78 coins. Some blocks already have like 0.2 coins is very common nowadays. So we are approaching the time where the subsidy will be insignificant compared to transaction fees. Okay, so what is the problem? Okay, so the cost of including a single extra transaction in a block is negligible, basically. So if you already included some amount of transaction, to just include another one doesn't cost you anything. And if this transaction has some fee attached to it, even if it's a very, very low fee, then you will just include it and get this additional fee because it doesn't cost you anything as a miner. So that implies that the user will not offer high enough fees to pay for the security maintenance of the network. They will not offer enough revenue, enough payments to the miners. Okay, so this is a well-known phenomenon in economics that's called the tragedy of the commons. So as a group, all the miners would prefer to come to an agreement and accept only high fee transactions, because that way they will get higher revenues. But it is in the immediate self-interest of each individual miner to deviate from this agreement and also accept a low fee transaction for himself when he manages to solve a block. Okay, so we have a proposed solution to this problem, and this is to impose a value cap on each block. So for example, no more than, let's say, 1,000 coins, 1,000 Bitcoins can be transacted at each block. So this way, the users will compete for space in the block, and the users who will offer transaction with a higher proportional fee, the miners will prioritize and accept those transactions first, and this way users will compete and will give higher fees to the miners. And I want to differentiate between this idea and a data size cap that is actually in place in Bitcoin right now. There is a 1 megabyte data cap size. So that also implies that user will offer fees to the miners because they need to compete for a limited amount of space. But the data size cap doesn't differentiate between a user who wants to send, let's say, a microtransaction and another user who wants to send a high value transaction. And both of them, if they want to get into this block, then they will have to pay some fee, and the data size cap doesn't differentiate between these two cases, and the value cap is more fair toward the users in this sense. And also the data size cap is controversial because it is the users expect that the data size will accommodate the Bitcoin economy. Okay, so that was the problem and a solution. So why does proof of stake help at all? So the operating cost of a stakeholders compared to a miners are really negligible. So a miner has an electricity bill, and he has to pay for all the energy consumption for running an equipment that does these calculations all the time. My stakeholder can run on some Raspberry Pi that is mostly idle. So if even if all the users are willing to pay fees to the miners and they will do it because of the value cap that we propose to impose, it is still unclear whether the market can bear the cost of funding an adequate level of proof of work-based security. So an increased transaction volume in the future implies that the miners will be able to collect more fees in total, but it also means that there will be more incentives to attack the network because it has more value if there is more commerce that is taking place on such a network. And if we use stakeholders to help maintain the security of the network, then we get a better ratio of security to fees because the stakeholders have less expenses, so they may require less fees. So they have competition among them, and the amount of fee that they will settle for can be less than that of miners. And the last point that wasn't true when we started to analyze all of these ideas, but it is true today, is that there are this phenomenon that's called either multi-pools or auto-switching pools, where it's usually with S-script hashing cryptocurrencies that miners delegate their mining power to some pool administrator who selects which particular cryptocurrency to mine right now according to the dollar exchange rate. So this is a screenshot of some hashcow website, for example. So an auto-switching pool, so miners who delegate their mining power to such a pool obviously couldn't care less about whether they provide security for such a for these cryptocurrencies. They just want to earn as much rewards as possible. So there's also the issue of energy consumption. You see that I don't have a lot of time, so I think that I will skip most of it. This is about the centralized mining and why we think that we can also help here. So maybe let's just summarize this slide. So if you participate in a stake pool, so you want to delegate your stake to a pool, let's say with expectation, then in a couple of weeks you will earn 2 coins. Let's say that you have 100 coins in total right now. So if the pool is corrupt and runs away with your money, so you lose all of your wealth. And if you delegate only your hash power to the pool and you're expected to earn 2 coins and the pool is corrupt and doesn't give you your reward, so you only lose this expected reward, but you don't lose the rest of your money. So it is less likely that users will wish to participate in stake pool because it is more risky. And the other issue is that if we take the extreme case of solo mining, then as a miner, proof of work miner, you might run for several years and your equipment might break in somewhere along that time, and you will spend a lot of money on the energy consumption, and this is quite bad. And as a stakeholder, if you have a small stakeholder that needs to run for, I don't know, several years until he collects his reward, so if he fails to collect the reward, then okay, so we fail, but other than that, nothing bad has happened. So either solo mining or participating in small pools with high variance is more likely with stake pools than with proof of work pools. So what I said is rational analysis, assuming that everybody is rational and agree with that. And in reality, like here there are screenshots of a pirated 40 Ponzi scheme and other Ponzi games that people are perfectly willing to give their coins away according to some promise that we'll get more coins back in the future. So reality is more messy than this rational analysis. Anyway, that was a summary of the problems with Bitcoin that we are trying to mitigate. So let's now describe the protocol. So the main procedure is this follow the Satoshi procedure, where we take a random looking number, treat it as an index between 0 and all the coins that have been minted until now, and then we follow the transaction history until we reach the unspent output that now controls this transaction, and this gives this linearity property that if say Alice has 2 coins and Bob has 6 coins, then however way that those coins are fragmented, if we start with some random Satoshi, the smallest units of the currency, and we just see where it goes, it will be 3 times more likely to go to Bob compared to Alice. So this is a diagram of how the final mix of proof of stake and proof of work protocol that we came up with looks like. This is after many discussion on Bitcoin Talk and trying to converge on variants of this protocol until we reach the one that has the best properties. terms of bribe attacks and so on. So there is a miner who tries to create a block with proof of work, and this derives some random looking number. This block doesn't actually contain the transaction yet, and this random looking number derives a random stakeholder who are supposed to sign this block. So there is this parameter n. This is an amplification parameter for how many stakeholders need to sign the block. It can be n equal 1. That's a good one of the good options. And the final stakeholder who signs the block also decides which transaction to include in this block. So see that I don't have a lot of time, so I just mentioned briefly that if n equals 1 and the attacker has 10% of the power, then we will need to compensate for that by being 9 times faster, having more hash rate than the honest network, with the amplification rate of, let's say, three stakeholders that are derived from each block. Then we need to compensate by actually being more than 700 times faster. So let me skip some of the other properties that needs to. So I should mention that there is no deadlock. So if a stakeholder is offline, is derived to create the next block, but is offline, then the miners will continue to compete to get rewards, and another stakeholder will be derived by another miner, and this how the readjustment of the difficulty. It will be done both according to the mining power that participates and the amount of online stake that participates. We can also measure and differentiate between them and incentivize a higher stakeholder participation level this way. So this is some security analysis that I will skip. So in all this kind of security analysis, there can be self-interested stakeholder that it is costless for them to collude with an attacker, but if they do that, then and the attack succeeds, that everybody sees that more double spending attacks occur in this kind of a network, and then the value of their stake diminishes, so the attacker might need to bribe stakeholder to participate in this attack, and then the attack becomes more costly. So all of these factors needs to go into such an analysis. And also, there can also be an attack that denies transaction in block. And in this protocol, we have it gives a nice and elegant solution to this problem, because stakeholders, at least the majority of the stakeholders, would not want to see empty blocks in the network, because this will also diminish their stake. So this is a table with the cost to an attacker. So seeing the number of coins needed in that column, that it is measured in the million, for example, in the third row. So 4 million coins, if he has 20% of the total stake, 20% of 21 million coins is 4 million coins. Plus, he needs to be 8 times faster, so 88% of the hash power. And this is a continuous chart. So these are the last 2 slides. So if we do a cost analysis of this protocol, then if I take some exemplary numbers right now, so you can buy some ASIC mining unit that costs 3.2 bitcoins and give you 2 terahashes, and the total network has 260,000 terahashes. To mount a 50% attack, you need 130,000 units, and this will cost you, so times 3.2 coins, 415 coins. And if we compare that to the previous chart, where we said that an attacker on this proof of activity network will need 4 million coins to attack this network, so that's a lot of more cost to the attack. And that is under the assumption that this attacker has 1/3 of the online stake to 20% of the total stake. And if the amplification parameter towards stake is 3, so and we say, for example, that in the proof of activity network, then the total amount of stake, total amount of hash power that participate in this network is, let's say, 1/10 of the Bitcoin network, the 26,000 terahashes, then the attacker will also need 8 times that to get equal amount of hash power to the rest of the network, to the honest network. So we will need to buy high mining equipment for price of about 330,000 coins. So this kind of networks, if under those assumptions, the energy consumption is better than Bitcoin, it's 1/10 energy consumption of Bitcoin, and still the cost for the attacker is higher. So let me just conclude by saying that if your bias towards the proof of stake is negative, so you might ask, how come I designed some protocol and then the cost for the attacker is in the millions compared to Bitcoin? So that is true under the assumption that stakeholders actually maintain the security of the network, that stakeholders, honest stakeholders actually run on their computer some client that helps in the maintenance of the network. Under those assumptions, these numbers will be accurate. And also if your bias is in favor, is positive toward proof of stake, so you might ask, so this is a proposal for a protocol that is a mix of proof of work and proof of stake, and whether if we do a pure proof of stake protocol without the proof of work, would it give even a better security than this? So we have a follow-up work on that, but I wouldn't claim that, think that it's impossible to claim that such a protocol can be superior to Bitcoin in every respect. And this protocol that I presented here, I do claim that it is superior to either pure proof of work or to pure proof of stake. So, thank you.